This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Clairmont, and co-host, Tyler Andrews.
Hello. Welcome to Clear Money Talk. I am your host, Tim Clairmont, CEO and founder of Clear Financial Partners. And with me, as always, Mr. Tyler Andrews.
Thank you, Tim. We're back. We just recorded another podcast.
We did. We don't do two back-to-back very often, but it's that Wednesday morning one. If you listen to the other one where we said it was Wednesday morning and dark and dreary, it's a little less dark and dreary because it's the second one we're recording on that Wednesday morning. But we'll and you'll notice if you're watching it on YouTube that I'm still in the same shirt with the same suit.
So am I.
So, yeah.
We look good, though. So that's what counts.
That's great.
You know what we should do one time? We should do a podcast-a-thon.
Ooh, that
just
would be
one
fun.
day, we see how many podcasts we can record.
Oh, we'll never have anyone listen to them because there's like way too many that we would go through.
It'd be cool, yeah.
It would be fun, though. It would be fun.
It would be fun. Okay.
All right, so what's our topic? I know Tyler's got another one ready to go. This is going to be good.
It's going to be good. It always is. Okay, topic of the day. How does a backdoor Roth IRA work, and is it worth it?
Backdoor Roth IRA.
Yeah, so we're getting a little nerdy on this podcast.
Okay, this will be fun.
Talking about backdoor Roth IRAs. What is it? You've maybe heard your friends talk about it, or you've seen it on Google or the internet, and you're like, what does that mean? You know, I have a Roth IRA, but is it a backdoor Roth IRA? Well, why isn't it a front door Roth IRA? Like, what's the difference there? So maybe we could talk about who it makes sense for, what it is, the pros, the cons. And is it worth it is the last part of the topic.
Yeah.
So
it's funny. If you've heard of a backdoor Roth IRA before, then you'll know, this is something, or maybe you've just heard of it, or maybe you just clicked on this because you're like, I don't even know what a backdoor Roth IRA is. So if you've heard of it before, you might have an inclination and you just kind of want some confirmation. If you have no idea what a backdoor Roth IRA is, this will be a great education for you. We'll be able to cover the insights, and I think we could do it fairly cleanly and simply. So let's start with a Roth IRA real quick for those of you, because some of you don't know what a Roth IRA is, and that's okay. Roth IRAs, so IRA stands for Individual Retirement Account, by the way. If you're ever wondering IRA, you probably hear it used all the time like that. Individual Retirement Account. It's an individual account because it's in your own Social Security number. And the IRA is set up to enable you to make a contribution on an annual basis to a retirement account and get some tax advantages. And if you contribute to a traditional IRA and you qualify, there are some qualifications, you can get a tax deduction for your contribution. That's what a normal IRA does. So if you made theoretically $100,000 for the year and you contribute to a traditional IRA and you qualify for the tax deduction, let's say you put in $7,000 as an example, then it's as if you only get taxed on $93,000. The $7,000 is invisible legally to the IRS as well as your state income tax, Department of Revenue. So that's a way to save some money. If you're in Oregon, for example, and your tax bracket is roughly 12% federal and 9% state, in that example, that'd be 21%. You'd save 21% off of that $7,000 contribution. So translates to about $1,400, little $1,500, a little over between $1,400 and $1,500 of tax savings. And that might be your motivation to make that contribution. Saving $1,400 bucks in tax savings is not a bad deal.
No.
That's a traditional IRA. A Roth IRA, you put that same $7,000 in, and then you don't get a tax break now, but however much it grows to down the road, everything comes out tax free. So I know I was actually just having a conversation with my niece yesterday. She just turned 21, and she's so excited. She just opened her first Roth IRA. She's contributing to it, and we're looking ahead at how much growth she might have over the next 40 years from like 21 till 61 years old. And imagine the significance. I mean, just a $7,000 contribution right now, compounded over 40 years, could easily become $50,000. And in that example, that's $43,000 of earnings that have happened inside the account, and all of it, all $50,000 would come out tax-free after 59 and a half. And that's the nature of a Roth IRA. So if that's just a quick recap for you on Roth IRAs and traditional IRAs, hope that was helpful. Yeah. If you want to learn more, we have more information about Roth IRAs and traditional IRAs, but let's go to the question at hand, which is the backdoor Roth IRA. So why would you do a backdoor Roth IRA? I'm happy to answer this, but Tyler, I've been monologuing.
I'm happy to answer it too.
Go for it.
So you talked about what the IRA is, what a Roth IRA is. I'm glad we got that differential out of the way. The reason somebody would choose to do a backdoor Roth IRA, really the only reason is you make too much money.
Yep.
So the IRS Internal Revenue Service, they say, we're going to let people contribute to these retirement accounts. We want people to save for retirement. We don't want them destitute when they retire and then they have to live off of the government, funded programs. We want them to save money. So we're going to incentivize them to do that by giving them tax benefits, current tax benefits by the traditional IRA, tax deductions, or future tax benefits by contributing to Roth IRAs now and then getting the future tax benefits of it coming out tax-free, assuming that you qualify for those benefits by following the rules of the Roth IRA. But they also say the Roth IRA is really cool. It's a great account, right? You
That's
put
right.
the money
It says
in.
that right in the tax code. The Roth IRA is really cool.
Yeah, whoever wrote that, good work in the tax code. The Roth IRA is really cool. And they say, hold on, if you make too much money, we're not going to let you to contribute to it because it's too cool for you high-income earners, I guess, is what they're trying to say.
Yep.
But there's also rules in the tax code that are in there for you to take advantage of if you understand them, where they say, what if you, instead of contributing directly to the Roth IRA, you make what's called a non-deductible IRA contribution, and then you immediately convert it over to the Roth IRA because they let you, doesn't matter how much money you earn, you can convert pre-tax retirement monies into post-tax Roth IRA money anytime. There's no income limits or anything on that. Same thing for a non-deductible. So you don't get it deducted from your income when you make a non-deductible contribution. So you put it in the IRA. That's the backdoor method, and then you convert it and get it into the Roth IRA. That's where the backdoor comes in. It's basically another step in the process, and you have to do that if you make too much money. They index it for inflation all the time, the amount of money you can earn based on if you file single or if you file married filing jointly, your taxes. If you make less than 150K as a single person or you're filing your tax return single, you can contribute directly to the Roth IRA. If you start making above 150, you start to get phased out, and then I think it's above 160 or somewhere in that neighborhood for 2025. You can't make any contribution to a Roth IRA. For married filing jointly, if you make less than 236,000, you can contribute directly to the Roth IRA. If you start making above that, that's where the backdoor Roth IRA might start to make sense for you. So that in the gist, that's where the backdoor Roth makes sense. Is essentially you make too much money, you have to take that extra step to get the money into the Roth IRA. There's other nuances which we'll touch on here shortly, but
I'm gonna recap kind of the quick gist of it there. So if you make over $250 a year as a married couple, you're gonna want to look into backdoor Roths because you're not gonna be able to contribute. You make over about $150, you're gonna want to look into backdoor Roths as a single person because you're gonna run into some challenges with contributions directly into the Roth IRA. The Roth IRA is oftentimes the very first place that I'll encourage clients to save. Now, if you don't have a match at work. If you have a match at work on your retirement account, that's the first thing to take, the free match money. And then the second thing to take is typically that Roth IRA contribution. But the point here is that Roth IRA is so valuable because of all that tax-free money you can have come out later. A lot of people want to take advantage of it. And the Roth conversion is set up so that there are no income limitations because, frankly, if you do a big conversion of an IRA account and you have to pay taxes on it, if there's a large amount, like for example, let's say you have a 401k account that has $100,000 in it, you want to convert that to a Roth IRA, you'd have to pay taxes on all $100,000. The IRS would like to get that tax revenue. So they don't put any income limitations on Roth conversions because they want you to be able to do those conversions in order for them to get paid the taxes now, because tax dollars today are more valuable to your leadership than tax dollars down the road. They like having that money coming in now. So that's why Roth conversions don't have any income constraints. But within that same ruling, we're able to then say, hey, well, what if we just contribute to a traditional IRA, as Tyler said, that may not where you may not qualify for that tax deduction. When I was talking about traditional IRAs before, I alluded to the fact that some people will contribute directly to the traditional IRA and be able to get that tax deduction. $1,400 was the example I gave you. But there are other people, if you have a retirement plan through work, for example, and your income is too high, you can't contribute to a traditional IRA and get a tax deduction. It would be what Tyler referred to as a non-deductible IRA contribution. And if you're going to put the money into a non-deductible IRA contribution, why would you want to do that if you don't get a tax deduction and still pay the taxes on the earnings later on down the road when you take that money out after 59 and a half? You'd still pay normal income taxes on all the earnings. But if you put it in that non-deductible IRA account and then you convert it to a Roth IRA, you actually don't have to pay taxes in the conversion. If you just put in, for example, $7,000 of a non-deductible contribution, you convert it to a Roth, there's no pre-tax money in there. Therefore, you don't have to pay any taxes, and you can still get that money into a Roth IRA, even if you have income in the 300, 500 million plus range. which is where the backdoor Roth IRA concept comes into play. Yep. So it's worth it's a nuance, but fundamentally, just know that there are ways to contribute. And one of the things that I think is really important to bring up is account aggregation. That's something that we have seen clients get caught with before when they look into this backdoor Roth concept.
The Pro-Rata rule.
Yeah.
Aggregation. Yeah. Happy you're touching on this.
You don't want to make this mistake. I've seen people they don't do it through us. If they did it through us, they don't make this mistake. But if they do it on their own, a lot of times they end up making this mistake. So let me point this out for you. If you have a traditional IRA account, like that old 401k, for example, that you roll over, maybe you have a $100,000 traditional IRA, and you want to try to do a backdoor Roth, that's not going to work for you the same way. If you contribute $7,000 into that traditional IRA account and then you go to convert it, the IRS looks at your situation based on the total amount of IRA pre-tax dollars you have under your Social Security number. So they're going to look at that $100,000 account that's pre-tax. They're going to look at the $7,000 account that was a non-deductible contribution, and they're going to say what percentage, pro rata, as Tyler said, of that total of $107,000 in our example, does $7,000 represent when you do your conversion. And so 7 divided by 107 would be the fraction that would be tax-free, and the rest, 100 divided by 107 as a fraction would be taxable when you do the Roth conversion. So you'll end up putting in money, not getting a tax deduction on it, and then having to do, when you do the Roth conversion, ending up having to pay taxes on probably $6,800 of that or more in that conversion. And that could be a really big negative surprise if you were anticipating not paying taxes in that backdoor Roth situation. So pay attention to whether or not you have any other IRA accounts with pre-tax money in it, because that might be prohibitive for you for doing the backdoor Roth. There are some other solutions we have that we can work on with clients who do have that situation, but it's best to talk to your advisor about that.
Yeah, and the issue can perpetuate itself even worse because in your example, you pay taxes on the $6,800 of the $7,000 contribution. That still leaves $200 of non-deductible contributions that you haven't paid taxes on. That
actually $6,800 is left.
Yes, $6,800.
Yeah, non-deductible contributions
that you haven't paid taxes on. Yeah, you have to remember, and then you go and you maybe do this again the next year, and then if you don't remember the portion that was left behind, that gets added on top of it, and it becomes a perpetuating issue. And if you do that for long enough, not realizing this mistake, and the IRS catches you and calls you on it, they're going to make you go back and fix all of your tax returns potentially, maybe undo and unwind all those contributions. Like it could potentially be a really big issue. Yeah. So the bottom line is, if you're going to approach this strategy, because it's a strategy, it's not an investment, it's a strategy, do it wisely and do it with the right people to assist you with it if you don't know what you're doing.
That's fair. That's fair. I can tell you one other analogy. I think we're bringing this probably to a close fairly soon. Yeah. So one other analogy that might add value for you. I was taught this when I first started in the business, 21 years old, back in 1997, and I feel like it still holds true when you're trying to understand the concept of LIFO, or last in, first out. You envision that your account is represented by a bucket, and the bucket has rocks in it and water. The rocks are after-tax chunks of money. The water is pre-tax chunks of money. So if you have a traditional IRA account or a 401k account that is all pre-tax money, you have a bucket of water only. There are no rocks in it. If you contribute to a non-deductible IRA account and you put that $7,000 in, that $7,000 is all rocks. You have a bucket, and you just put a $7,000 rock in it. There's no water because there's no earnings in it yet. If you do this conversion, the IRS merges those two buckets together and says, hey, what's the total of the water and the rock? And then that's where you have that tax consequence. But what we were just talking about is you got about $200, let's say, tax-free of that $7,000 conversion in this example where you messed up and did your backdoor Roth. But that $6,800 is still sitting in the bucket as a rock, and you already paid taxes on it because remember, you didn't get a deduction on that contribution. Well, it's up to you to remember that rock's there. The IRS isn't going to do that. So when you go to tip the bucket over and take your money out later, what's the first thing that comes out of the bucket? The water. So you got to take all the earnings out of the bucket first and pay all those taxes. And then the last thing that comes out is the rock. And whose job is it to tell the IRS, oh, by the way, that was a rock? Well, that's yours. And if you don't remember, they're just going to treat the rock like water. And then you end up paying taxes on the money twice.
Yeah.
So don't make that mistake. The analogy can help you better understand kind of how that works and some of the minutia, but frankly, the easiest thing to do is just give us a call and work with us because we can help you figure it out and
help make it easy.
Not screw it up.
Yeah.
So.
I think that's good. We talked about what the backdoor Roth IRA is. Is it worth it? Depending on your situation, it can be very worth it. It can be very powerful for you, depending on your situation. So that all the stuff that we talked about earlier on the podcast filters into making that decision if it's worth it for you or not. So I'm good to go to just the answer if you are.
Okay. Sure. Yeah.
Topic again was, how does a backdoor Roth IRA work, and is it worth it? Do you want me to take this one? Do you want to do it?
No, okay, it's fine.
So
go ahead.
We first talked about the difference between a traditional IRA and a Roth IRA. Go back and listen to the full episode, or give us a call, or look into it yourself to figure out the difference there. And then we talked about why people might choose to do a backdoor Roth IRA and what it is. Essentially, if you make too much money, the IRS prohibits you from contributing directly to a Roth IRA. There's a strategy that exists, the backdoor Roth IRA that we're talking about, where you contribute first to a traditional IRA in a non-deductible capacity, and then you convert that non-deductible contribution to the Roth IRA. Hence, the backdoor Roth IRA strategy was born. That's where that comes from. Common mistakes to avoid with the backdoor Roth IRA is called the Pro-Rata rule, or the aggregation rule, where the IRS looks at all of your pre-tax retirement assets in traditional IRAs, basically outside of qualified employer-sponsored retirement plans, and they look at how much of the money that you're contributing to the backdoor Roth IRA is non-deductible, and then they aggregate those things. So there's more nitty-gritty, more nuts and bolts on the aggregation pro-rata rule. Just make sure that if you're doing this strategy that you take that into consideration, because it could potentially mess up the backdoor Roth contribution. Yep. There's more details in our podcast on that as well, the full version. Other things that could potentially go wrong with the backdoor Roth IRA is not doing the backdoor Roth, just contributing directly to the Roth IRA. So make sure that you first do the non-deductible contribution to an IRA and then convert it. And that's also where people can potentially go wrong with this.
That's right. If you make a contribution to a Roth IRA directly and you didn't qualify to do that because your income was too high, they'll force you to take it out, and you'll also have some taxation on any earnings that it made while it was in there. So pay attention to all of that. That's not an ideal scenario either. But the bottom line question here at the end was is it worth it? And the answer is, if you don't have any screw ups taxation wise, yes, it's worth it.
Yeah. So, bottom line.
Yeah, and make sure that if you work with a professional, there's a high probability that you're not going to make those kind of screw ups. Yeah. As long as you're fully honest, you can't not tell them about a traditional IRA account that you have and then blame them when you do the backdoor Roth situation and you didn't tell them about the other IRA account you had when all of a sudden the consequences pop up. You got to be forthcoming about everything you have going on too with your advisor in order for them to be able to truly help you. So,
Yep. Okay, you ready for
all
trivia?
Right. Yeah, let's
all
go.
Right, let's do it.
All right.
Which classic rock band was originally called Smile before changing their name and becoming world famous?
Oh my goodness.
Oh, yeah.
Smile.
Would you like some options?
Interesting. Yeah, I think I'm going to need options for this one. Like sometimes I just know right away what it is. But go for it. I need multiple choice.
All right, we got you.
Okay.
Option A is Queen. Okay. Option B is the Rolling Stones. Option C is Pink Floyd, and option D is the Who.
I was actually thinking initially the Rolling Stones. That was kind of my gut, and so I feel like I want to go with that one. I feel like Queen I watched the movie. I loved that Bohemian Rhapsody movie, by the way. It was a great movie. Yeah. I think the band already was called Queen before the lead singer joined, so I can't, even though his smile's obviously revolutionary. I'm going to go with the Rolling Stones. Let's see, and see what happens.
The answer is Queen.
Oh, Queen it was. Should have caught that. Smile. Well, I'm glad they decided to go with Queen instead.
Yeah. So we all learned something today, whether it was about the backdoor Roth IRA or whether it was that Queen was originally called Smile before they changed their name. So.
Well, that makes me just want to smile.
Yeah, me too. Me too.
All right. Hope you had a great time on Clear Money Talk. I think we'll go ahead and wrap it up there for today's show, and get all those money questions answered. That's what we're here doing this for. Take a look back at our old shows, see if there's a question you kind of wanted to know what the answer was, and check it out. That's why these are here. That's why we keep doing this. We want to teach 1 billion people something smart about money. And if you learned something smart about money today, please go to somethingsmartaboutmoney.com and get counted.
Thank you guys for your minutes. We'll see you on the next one.
Till next time.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetera Advisor Networks LLC, a broker, dealer, and registered investment advisor, member FINRA SIPC. Cetera is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisor Networks LLC. They should not be considered specific advice or recommendations for any individual. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Neither Cetera Advisor Networks LLC nor any of its representatives may give legal or tax advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half or due to death, disability, or a first-time home purchase up to a $10,000 lifetime maximum, depending on state law. Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59 and a half may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment sub-account values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying sub-accounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. Clear Financial Partners is located at 15573 Bangi Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.